What's up, guys? It's Downtown Josh Brown here with Michael Batnick. We're here for another round of What Are Your Thoughts? And somehow it's already like mid-February, so I can't believe it. Anyway, very excited. We have so many great topics to go over today. I haven't really spoken with Mike that much this week, so genuinely ready to catch up. Duncan's in the house. What? Did we hang out a lot this week?
It's Tuesday.
All right, don't step on my intro. Duncan's in the house doing viewer topics. So much stuff here, so stick around. Let's get into it all. All right, we know a bunch of people that were in this short sellers article that Kate Kelly and Matthew Goldstein did at the New York Times. Like, they referenced a lot of people. Maybe we don't really know them. We know them from social media. What'd you think of it, though?
We've been reading so much about this stuff.
Yeah.
That to me, this particular post was like the watered down version for the person that doesn't know anything.
Oh, Kate Kelly's going to love hearing that. So I think what they did here that's different than everything you and I have been reading, though, is they focused on the people who are not billionaires, but are short sellers for a living. And that part of it was interesting to me because I don't think these people can afford to hire security like the way that, let's say, a $12 billion hedge fund manager can. I don't know.
I love the stuff that they did on Mark Cohodes.
Yeah. He's a fucking badass, that guy.
So they talked a lot about
Wait, did you see Cohodes interviewed by Dave Portnoy?
No.
That was so good. I don't know Mark at all. I've seen him on Twitter, but I have a lot of respect for like just what he's gone through in his career. This guy has been like up against a lot of bad people and has survived it all. So I thought that you should definitely watch that. It was good.
So here's the quote. Mark Cohodes sought to distinguish between short sellers who focus on rooting out questionable business practices and illicit behavior and other hedge funds that use short selling purely as a betting strategy. In other words, of course, a lot of short sellers are purely momentum. They don't give a shit about the company, what it does.
Right.
Other people like him, they're like crusaders, right? Like short sellers used to be the heroes. In 2008, they were the heroes. Michael Burry was a legend. Jim Chanos for uncovering the fraud at Enron along with Bethany McLean. I mean, these people were doing like heavy lifting and deep like detective work that nobody else wanted to do. So I think that they serve an important function, and I don't love what's happened in the past few weeks.
I think where things changed, and they didn't just change recently, I think how they lost that heroic statute was they started going after people that have made investors a lot of money, like Elon Musk and like Chamath. And I think like
any other examples
of short sellers going up against popular people.
I just feel like it's the Tesla thing. Like take Tesla out of the equation.
Like Chipotle, like they start. Like I feel like it's not that the shorts didn't have a case against these people. I think that's where they lost the crowd. Because you're right, like. They were the heroes after 2009, 2010. Like even David Einhorn was short the housing bubble, and
Lehman
Brothers was like a big short for him. But they were saying unpopular things that turned out to have been true really rapidly. Whereas in recent years, when they've gone up against like Elon Musk, A, it was a big money loser, and B, he's like the real populist hero for most investors. And I think that's where they lost the crowd.
And C, it's also been a while. They haven't had a big victory.
Valiant
in a while.
There have been small victories that nobody really knows about.
But Valiant, aside from the short selling angle, it was not a pop culture story. Nobody knows who Valiant is or what they did.
It was the largest growth stock in Canada, and I feel like there were a lot of big headlines.
It's also 5 years ago.
You know, the last great short was not a public company.
Theranos.
Right.
But did anyone short that?
No, you can't short it.
Can't, yeah.
So,
and there's the bell.
We just got a bell, but I think that was the market open bell.
All right. I want to talk about small cap stocks. I almost can't believe my eyes.
Well, believe them because it's true.
So we know that they've been on fire lately, right? So over the last 6 months, they're up 47%. The Russell 2000.
This is nuts, actually.
Over the last 6 months, they're up 47%.
Yeah.
The S&P's up 18%.
Yeah.
Over the last year, now this includes the downturn, okay? We're going February to February. So it includes the downturn. Small cap stocks up 40%. And they were down more than 40%, I believe.
Huge round trip.
So they're up 40, the S&P's up 20. They're doubling the S&P over the last year. Now here's the crazy part. Even if you zoom back 3 years. 3 years. So think about where we've been over the last 3 years.
Okay.
It's been all about FANG stocks. FANG, FanMag, whatever you want to say. Tesla. It's been all about the giants. Nike, Disney, Starbucks, all about the giants, right?
Right.
Over the last 3 years, the Russell 2000 is outperforming the S&P 500.
But all of that happened within the last 3 months.
Yes.
Can I tell you what I think the takeaway is for that? So you have a 3-year period where almost all of the time it feels like anything other than S&P 500 is a mistake. And small caps are eating into your performance like every quarter, right? And then all of a sudden you get this burst for the Russell 2000 that not only completely eliminates the performance gap, but actually small caps catapult ahead of what felt like the winning trade through the whole period. And my takeaway is that's why asset allocation is usually a superior strategy than trying to decide this is a good time for small caps. No, this is a good time for large caps. I really think you have to be in it to win it because of how sudden those performance shifts can change.
So the gap was super wide. Like this chart that we're showing, this starts in February 2018. All the way to around September 2020, the gap was super wide. The S&P was outperforming 43 to 11.
That's crazy.
And then from September to today, all of that gap was made up. It's like I put this on the blog, that GIF of DK Metcalf running down the cornerback from the interception. That's what just happened with small stocks and large stocks.
Because here's the narrative until the summer.
But what happened? How did this happen?
I'm telling you.
I understand why small stocks got killed, why they've been underperforming. But is this all stimulus? Is this all looking forward and people being in better shape coming out of the recession?
Up until the summer, the story was all of the whole reason stocks are going up is because people throwing money into indexes.
Right.
And the indexes are just buying the favorite largest stocks. And it's a self-fulfilling kind of like upward spiral for the S&P 50, let's say. And then all of a sudden, vaccine shit got real. And people said, oh yeah, small caps outperform large caps in recoveries. The recovery's happening. But then that's just the first 3 innings. The next 3 innings are everyone doing what people just did. That's how momentum works. It's the next wave of people coming into the Russell don't even think. They just buy what just worked. And that can go on for a while. So I think we're in the 6th inning of a 9-inning game. And I don't think I'd want to be out of small caps just because they've had a huge run. I really don't. Just like my personal opinion. So, all right. I want to get into where was I going? I want to get into the Bumble IPO. So you and I are happily married. We're not on dating apps. I know some people who are. I'm sure you do too. This one I think is going to be a smoking hot deal. Like I think it's going to go nuts. And I'm not a big IPO player, but if somebody offered me shares in this, I'd probably say yes.
Is it a traditional IPO? What are they doing?
It's an actual IPO. So they're going to do 45 million shares priced between 37 and 39. Do you agree with me? Just automatically close your eyes. You know this thing's opening over 70.
I mean that's the market that we're in right now.
That's the market we're in right. Investors are just out of control, insatiable for. So this will be traditional IPO. Most of the stock is owned by Blackstone, which is interesting. But also interesting, Whitney Wolfe Herd, who is the founder, she's 31 years old. She will be the youngest woman ever to bring a company public as a CEO.
Wow.
And this actually, I think, was owned by a British company, like majority owned. She came from Tinder. And then this guy that had a big British dating app gave her a shot to launch a female. The difference between Bumble and all the brands that Match owns is that women are in charge on Bumble. So they can control how much messaging, and they can make the first move if they want to, which is good because men are disgusting for the most part. So this is hugely popular, 100 million users around the world. But I could see this thing. This thing's already been upsized once. I could see a huge open. I was looking at Match Group, January 2020, all the bars close in February or March with the onset of COVID, and the stock drops to a $7 billion market cap from 13. Now it's worth $42 billion. So when you think about the size of the industry, there's definitely room for two players, I guess is my point. I don't know. What do you think about Bumble? I know you're not a user, but from a deal perspective.
I've never thought about Bumble, but I do like the idea of having women control the conversation for obvious reasons.
Right. I see big things for this. Every ESG portfolio is going to own it, right? Like every ESG strategy that focuses on tech. I think it's going to work. What do you got?
All right, let's talk about SPACs. I know we've been talking about them a lot, and I wasn't going to bring this up, but Michael Sembles at JP Morgan just did this kick-ass post. And given that we're talking that a lot of the conversation over the last few weeks has been how the game is rigged. Okay.
Totally rigged.
If any part of the market is rigged, or maybe not rigged, favors people with money, it's SPACs. Some of the data in here is unbelievable. And we'll get to that in a second. But I just want to lay the groundwork with this quote from Jimmy Cramer. He said, "These newer SPACs increasingly feel like an inside joke for the super rich and a way for celebrities to monetize their reputation." So we've got A-Rod, Shaq, Paul Ryan, Billy Bean, and they're not stopping.
It would be easier to say who doesn't have a SPAC.
So why are they doing this? The returns that SPAC sponsors generate, I mean, it is ridiculous.
What's the number?
They looked from January 2019. So basically, they looked at the last 2 years. SPAC sponsor returns, the average is 958. The median is 682. The 15th percentile, meaning like you're 15 out of...
Time out. The average return for a SPAC sponsor is 958%, almost 1,000% on their money.
Over the last 2 years.
Dude, what else can you do that the average return is 1,000%? Think about how big that return is in 2 years.
The median is 682. Again, the crappy ones, the 15th percentile is 178. The good ones in the 85th percentile, 1,700%.
What is 1,700% on $1 million investment?
It's 16x your money.
16 times your money.
So
it's like outrageous.
Even net of fees. I mean, you almost can't lose is basically what Michael Sembles was saying. So then you look at the difference between retail access to SPACs. So there's a SPAC IPO you can buy and get in before an announced merger, right? Or you could buy after the merger is announced. What are those returns? They suck. I mean, they're not good. So
No. Time out. If you buy it before the deal is announced, they're actually pretty damn good. They're just not as good as the market. But on absolute terms, they are good. It's when you buy after 180 days of the deal having commenced, those are the losing returns.
Hang on. SPAC investor buy and hold gross return. The median is 45%.
Yeah.
Which sounds pretty good, but until you
relative
consider
to the market,
until you consider what sort of market we're in. So relative to the Russell 2000 growth, it's negative 21%. However, there's so much going on here because the standard deviation is all over the place. So if you choose correctly, you could hit a grand slam. The investors that buy after the merger is announced have done even worse. Here's where it's rigged is the wrong word, but where it favors the wealthy is, first of all, the sponsors. Again, that's basically free money for them. But for the institutional investors that have access, that could basically say, no, give us our money back. We don't want to go ahead with the merger. Like once the deal's announced, if they do want to go ahead with it, they can get warrants and other sort of concessions or just better deals. So this is the like poster child for rich people.
You're missing the big one. The
Please.
Fees, it's not a commission. You literally get 1% of the company. So like the report on Clover Health, like the short seller that Hindenburg went after Chamath last week, like Chamath can refute all the stuff about lawsuits and, you know, the people involved in the company, whatever. I don't even, like I glossed over it. The big picture is that you secure the promote. It's called the promote. You put in X dollars to be the founder of the thing or the face of the thing.
And you take a huge rake.
In the case of like Clover, Chamath is so famous and drives so many investment dollars to follow him. They were saying he put in $25,000 cash and he ends up with
like
a
the
20%.
like the filing fees or whatever.
Yeah, he ends up with a stake of like 20% of the company post deal closing. So he ends up with a $290 million stake in the company for putting up almost nothing other than his face.
That's a good
and
return.
His name.
So I think this is the cherry on top from Sembalest. Quote, the SPAC ecosystem involves significant wealth transfers from buy and hold investors to SPAC ARB investors and from companies going public to SPAC ARB investors and SPAC sponsors.
Yeah, there's a lot going on here. So far, everyone's winning, but all of those percentages are going to narrow. And then that wealth transfer that Sembalist talks about is going to come into focus. Like, who's really benefiting the most? So far, again, you have enough demand. Nobody feels like they're losing in any part of the puzzle.
And there's been a lot of huge winners. Obviously, there's been big losers, but it's not like these are shit coins. It's not like everybody's getting wiped out. So,
Mike, when the company announces a deal and you don't like it and there's no premium, you can just literally get your cash back. It's
I don't think retail investors can. Institutional,
you sell. Institutional investors can, but you could just sell if there's no pop. Like, remember when they announced SoFi?
But what if there's a negative pop?
What if
that
happens? Drop? That happens. But let me say one thing that maybe is being lost in the conversation. Most of these are trading at a premium before the deal is announced, so they'll lose the premium.
Right.
So most SPACs come out at $10 a share.
Right.
And if somebody like Chamath's involved, they're like 20 immediately. Let's say he announces a shitty deal. He's like, "Oh, we're gonna resurrect Roy Rogers or something." The SPAC price will drop. It's probably not going to break 10, which is how much cash it has. So you almost get like a mulligan if you're an investor in these things. Like, I shouldn't have been in it. I'll just get out, and you get back your cash.
Sounds like a free lunch.
It's very hard to lose right now. Is all I'm saying. It won't always be that way. All right, we got to move. Brian Westbury at First Trust. Shout to Brian. Had him on the podcast the other day. This is him, and he is not an MMT guy. He's from the Chicago school. So Westbury said, quote, inflation is not dead. It is not gone. It has not been tamed. M2, which is the money that's circulating in the economy, different than money that's sitting on bank balance sheets, is up 26% over the last year.
I know this doesn't help because I don't have it at my fingertips, but St. Louis Fred did a blog post recently on how some of the M2 stuff was reclassified, so it's not quite as jarring as these numbers sound.
Right. So, but it's definitely the biggest growth in money supply ever on an annual basis.
Yes.
And it's double the average since the 1970s. So this feeds into a lot of the investment stuff that you and I end up talking about and why things are being valued the way they are and why investors are behaving the way they are. A lot of that is a function of this. So Westbury's saying 10-year Treasury yield has risen from 0.6% in May to 1.2% today.
Big deal.
I think that's headed to 2%. Then he's talking about commodity prices surging and the sugar high in equities, and we're not there yet.
Commodities. Have you looked at oil? Oil's almost back to $60 a barrel.
Oil was negative.
Up from negative, so it's up a few several infinity percent. I don't even know how you do that math. Look at copper. Dude, copper is on fire. So these are some industrial, obviously big inputs here that we're talking about.
A constructive person would say that's not inflation. It's actually demand. Just a sign of demand coming back. And it's not bad. But it's still inflation in terms of prices relative to where they were a year ago. And then he's bottom line, we aren't there yet, but markets are floating on a sea of new money. In fact, it's more like a tsunami.
Here's the money line for me.
Go ahead.
The difference coming out of this recession versus all other times is that the American consumer has never been more flush with cash. Combined, Americans saved about $2.9 trillion in 2020, more than doubling the previous record high of $1.2 trillion in 2018. So the upshot is that when the economy opens up, when we're allowed out of our houses and businesses are open, the spending is going to go berserk. And so, yeah, can I see the case for higher inflation? Yeah, I can.
Yeah. So I bought Live Nation for this reason. I should be buying Vegas hotel chain. I know they're all up off the lows.
Dude, buy lumber.
I just feel that. By the way, how did Americans save $3 trillion in 2020 if the economy's so bad? That's what happens when you indiscriminately send money to everyone and they can't go do anything with it.
What are lumber futures? I mean, this was going nuts a few months ago.
That's building houses. It's enough with the lumber, Jeremy Grantham. We got it. Timber.
Hey, you brought up inflation. All right, stock picking.
How's it going?
Sentiment Trader threw up this wild chart. The percent of stocks beating the S&P 500 over the trailing 12 months.
I don't understand this. Can you explain what's going on here?
Yeah, I can.
These are S&P stocks?
These are S&P 500 stocks.
Okay.
So over the last 12 months, eyeballing it, looks like around 35%. And what's interesting, cue the scary music, Duncan, is this has happened at a few prior market tops.
But what is happening? People's individual stocks are not doing as well.
There are fewer and fewer individual names beating the index, which is not shocking considering how many stocks in the S&P 500 got killed over the last 12 months. All of the retail, hospitality. Now, I bet if you flip this and you change this to like over the trailing 3 months, I bet this looks the opposite.
I was going to say, I bet if you did this with Russell 1000, there would be a lot more stocks doing well.
Over the last 3 months, I bet the number is, I'm making it up, 60%. Like a lot of stocks are crushing. But anyway, this happens at market peaks because the gains become concentrated and there's fewer and fewer stocks participating. So this happened in the top in 73. This happened at the top in 2000, obviously. I don't think that this is anything necessarily to be nervous about.
The part I don't understand is how does this square with the idea that the Russell 2000 is beating the S&P and so many small caps are doing so well, and mid caps.
The Russell 2000 is not the S&P 500, stating the obvious. So let's look at like the RSP, for example, the equal weight over the S&P. Okay. So over the last year, the S&P is outperforming by 2.5%, the equal weight version. But again, to our point, over the last 3 months, the equal weight is outperforming by 6%, 18 to 12. So change the start date on this, or change the time period, and it probably looks a lot different.
I'm going to choose to not be worried about this at all. How about you?
I just said I'm not worried about it. I think I still like the chart.
I'm going to pretend you didn't even bring this up.
Too late.
Let's do some viewer. What are your thoughts? Topics. Let's hear from Duncan Hill. Come on, Duncan. What do you got?
Hey guys. We got some good questions this week. First up for you, Josh. DK has a question about the Wall Street Bets saga. They ask, how is what happened on the trading platforms legal? They flipped a switch on stocks like GameStop and AMC and only allowed selling, causing all of the trend stocks to tank in a coordinated fashion.
DK, look into my crystal blue eyes when I tell you this. It's legal, but it's fucked up. It's not right, okay? But, like morally, but it's legal. And brokerage firms legitimately do have net cap requirements and huge swings in very heavily concentrated positions that they're involved with will change the math on how much they have to have on hand, which is why you saw Robinhood not only halt trading those securities, but also have to post more capital. They did a huge capital raise. I think they did a really shitty job explaining that and communicating that up front. But I want to take you back to something older that we said as a firm 2 years ago. Barry Ritholtz my partner Barry probably wrote 10 different Bloomberg columns saying the same thing. There's no such thing as free trading. There's no such thing on Wall Street as a free lunch. So if you're not paying commissions...
Except SPACs.
Except SPACs is a free lunch. You're guaranteed to win. If you're not paying commissions, someone's getting paid some other way. So in this case, Robinhood, being a non-seasoned operator, did not see what was coming in advance and ran into a situation where they literally couldn't handle the positioning inside of the broker-dealer.
They got margin called.
Dude, I worked at firms that had net cap violations. They got they had to settle and pay huge fines to the regulators. It's a real thing. And this is obviously on a much larger scale than anything I've ever seen in person. But the answer to your question is it's not right. It definitely broke the momentum in these stocks. It definitely broke the back of what the Redditors were doing. And that doesn't mean it's illegal. And back to another thing I've said, which is that Wall Street always wins in the end. So here's another case in point. All right, what's next?
Hey, Michael. So Kyle asks, what would you tell clients, friends, family members, etc., if they were scared to death by doomsday predictions like those from Harry Dent?
Well, I get this email fairly regularly. I got an email yesterday about a guy who was going down the James Rickards rabbit hole and wanted my opinion. And anytime I get an email from somebody reading one of these doom and gloomers, I send them Morgan Housel's post called The Seduction of Pessimism. That's my answer. Read that post, send it to everyone that sends you a James Rickards or a Harry Dent book, or Google Harry Dent books. I mean, that should help you find the comedy in this.
He's been one of the most destructive voices in the investing realm for maybe 2 full decades, in terms of like how nastily pessimistic he's been, how wrong he's been, how ill-fated the timing.
So
I'm sure he's a nice guy. I'm sure he's a nice guy. Just don't fucking listen to him.
Okay, how's this? I don't know that I'd give him the benefit of that doubt. The Great Depression ahead, 2009.
Good call, Dick.
The Great Crash ahead, 2011.
How'd that go?
The sale, 2011, we had a 90% drawdown, so I think he actually...
So he wrote it during.
Joke's on you, Josh. 2011, the Great Crash ahead. I'm sorry, I said that already. 2016, the sale of a lifetime. 2017, 0 hour. Ooh. 2014, the demographic cliff. I mean, these people are preying on your worst instincts. Do not read them.
Just look at the titles. The cliff.
I'm saying.
0 hour. Like the titles of them alone.
They're meant to scare you.
I hope he's not following his own advice.
What to do when the bubble pops? That was 2015. How did I miss that one? This is random. He wrote a book called Be Your Own Boss. Did he pivot from a market timer to a motivational speaker?
Was that co-written with the other charlatan, Kiyosaki? Yeah. Listen, the one thing to remember about the people that are calling for a top every year, the game that they're playing, it's a martingale strategy.
How to prosper during the global meltdown. I mean, it's ridiculous. I don't know.
When was that?
Whatever.
1995. So the thing to remember is that they're playing a martingale strategy. One of these days, the market will top for a period of time, and there'll be an ugly crash. And they'll say, see? And they'll hold up that latest book. Please don't be fooled by this.
What pisses me off is the I'm just trying to protect you attitude that some of these people have.
Well, I think some of them are convinced of that. He might be. That gets back to type 1 versus type 2.
Right.
I don't want to spend any more time on this. Oh, we have a collab to announce, and I'm really pumped for this. Some of you might be familiar with the Earn Your Leisure Network, aka EYL Network. They do Market Mondays on YouTube. They have a hugely popular YouTube channel, Instagram channel, become friends of mine, and we're going to do a crossover episode with the Earn Your Leisure crew. So it'll be me, Mike, and Ben from the compound. And I look at this like when the Avengers met the X-Men and did a team up.
When did that happen?
I feel like it happened maybe in the comics, not in the movies. All right. Anyway, Troy Billings, Rashad Bilal, and Ian Dunlop, who are on the Earn Your Leisure crew. These guys are super savvy. We're gonna have a lot of fun answering personal finance questions from their audience and from our audience, and we're going to do it all together. So it's going to be 7 p.m. this Thursday night right here on the compound. The whole crew will be out, and we want you guys to come by. And if you want to submit a question...
Wait, when is it?
This Thursday night.
This Thursday night.
7 p.m.
I'm free.
Good. We would make you free otherwise. All right. So if you want to submit a question for that, it's going to be askthecompoundshow@gmail.com. Send us what's on your mind. And amongst the 6 of us on this crossover episode, someone's going to have a good answer for you. So look for that. If you're not subscribed, you're not getting these notifications. I don't know what to tell you. You got to subscribe to the channel. Leave us a rating and review. They go a long way. Leave us your feedback. Let us know what you think about all the topics we discussed tonight, and we will see you very soon.